But right now, let's bring back in my co-host, Jeff Small, along with our guest and good friend, Jon Najarian. Jon's the author of the new book, Follow the Smart Money, along with his brother, Pete. He's also co-founder of Market Rebellion. Jon, thanks so much for being back on the show with us.
Great to be with you. Thanks, David. Thank you, Jeff. I'm looking forward to it.
Yeah, so it was about 9 weeks ago we last had you on the show. And I just have to say one thing. You were right. You're right. You said you thought the bottom of the market was in, unless there's a huge second wave of infections. You thought things would go up. But let me ask you, are even you surprised about the extent to which the markets have recovered and how quickly they've recovered?
I don't mean to sound cocky about this at all, Dave, but no, I am not surprised. I think the people that were most surprised are my colleagues that are based in New York City, because as wonderful as New York can be, it was the center of the pandemic in the United States. And hearing those sirens every night and knowing how many people were getting infected, were going into hospitals, getting on ventilators, they had a very different view of what this pandemic was doing to the country, because they basically thought that's happening all over the country, and it wasn't. And as parts of the country then, Dave and Jeff, began to unlock, began to reopen, which in some parts of the country now is going on 5, even 6 weeks. As that happened, New York was just shaking their head collectively saying, oh my God, we're all gonna die. And nobody will go out ever again to a theater, to an airplane, to a hotel, to a cruise line. And that's where they were dead wrong. So again, not cocky on my part, but I'm lucky that I don't live in New York, because like you guys, I get a perspective of other parts of the country, not just New York City. A lot of my New York-based friends only have that New York state of mind. And that was the wrong view of the rest of the country. So to see us come back, to see jobs make that huge turn from an expected, loss of 8 million jobs to actually creation of jobs of 2.5 million or whatever, those sorts of things shock New Yorkers. And it doesn't so much shock me, because I know a lot of people who were going back to work personally, and yet in New York, they didn't know anybody who was going back to work.
It's funny, you're right, it's a regional thing. At first, when the president said each state has to make their own decision, I thought that was a bad decision. I thought he was just passing the buck to the states. But now I agree with you, it's so regional that really that was the only way to do it. So I guess the question now, I know that Jeff is dying to ask, is about the future. Jeff?
Yeah, so Jon, this question really is for our listeners and our viewers. And so we've really reached the moment of peak impact with the great unemployment numbers we had, that $9 million swing in a month, combined with the Fed stimulus and the fiscal stimulus. If you're an average investor today, is there more upside to the market, or is there more risk? Talk to them. What would you tell them today if they asked you that question?
Okay, Jeff, and it is a great question, and it's one that I think the three of us probably wrestle with a lot too. Clearly, with the market 40 some odd percent off the lows, I think I would be dumb if I said, oh, it's not more risky now. It's more risky than when the Dow was at 18,000. Now that the Dow's, pushing back, into the 25, 26,000 range, I'd be dumb if I said, oh yeah, there's less risk. However, with 2.3 trillion coming from Congress in the form of various supports for hospitals, for testing, for mom and pop businesses and things like that, those augmented checks that people are getting for unemployment. And then from the Fed, that other $3 trillion that's coming from the Fed, none of us are going to dismiss that 5 trillion to, maybe if it gets levered, more than that, more than $7 trillion that's basically chasing capital. That capital is chasing, it's looking for yield. And I think that is why, even though there's more risk, there's a bigger support under where the market is right now than there was when we were initially on that drop, falling to 18,000.
So John, so 45 seconds left. So bottom line is you believe that even at these levels, we still have a little bit more upside potential than we do downside risk today.
Yes. And stocks like Apple, where they've got a breakthrough technology, 5G, that's going to be coming in their new handsets. We virtually know that. And we know it's going to be announced, I'll tell you, right around the 10th of September is when they usually do that. And that will be a game changer. And it's going to move a lot of different markets, AT&T, Verizon, a lot of the component makers for Apple, and of course, Apple itself.
You know, after the commercial break, I want to talk to you briefly about which sectors. It's clearly more of a stock pickers market than it is an index buyers market. So I want to ask you about which sectors, because you were right last time. So I'm hoping you're right again. Give us good advice. But we need to take this break right now. You stay with us. We have much more coming up from our good friend Jon Najarian right here in just a moment. We'll be right back. Now let's welcome back co-host Jeff Small, along with our good friend, author and options trader, Jon Najarian, co-founder of Market Rebellion. John, thanks for sticking around.
Sure. Thank you, David. Jeff.
So I've got to spend at least a few minutes, even though, you know, you're not a real estate guy per se, you're a market guy, but the show's about real estate. So when we spoke 9 or 10 weeks ago, you said you don't think the Fed's going to go negative interest rates. But a lot of studies today show that a lot of real estate buyers have come out of the market and they're sitting on the sidelines. So what happens if that doesn't come back? To me, the only way to really get that moving is to have, essentially, is to have negative interest rates. Because right now, the carrot of having banks, you know, have essentially earning no interest when they put money at the Federal Reserve is one thing. But they might need the stick of actually having to pay money on their reserves so that they actually make these loans and get the market going again. Do you think the chances have increased at all of negative interest, or do you think they've decreased?
I think they're about the same. They're still, I believe, quite low, the chances of negative interest rates, Dave. But that doesn't mean an impossibility. You know, when Jay Powell was before Congress this week and he was talking about, you know, we have not exhausted all of the things that we can do. They did ask him about negative rates. He said he didn't think that that was some place that we'd go, but he said, you know, basically it's all on the table. Anything's possible. You and I would say that when you look around at businesses, many of which might have fewer people working there in the home office, and a lot of them might be working instead remotely, you don't need as much real estate then. So I think that kind of office space development is something that I would question as to whether I want to be too much in that. But I like other plays in the real estate space a lot, like Store Capital, for instance, STOR. This one's a place that basically they go to the person that has that CVS and they say, okay, wouldn't you like to cash out of that building and instead rent it from us? And now you have more capital to put another CVS or Walgreens or whatever it is. In other words, I think those kinds of places, rather than office space, are where I want to focus for real estate. Yeah. That, of course, and residential.
Good point. And you're right. The demand decrease of demand is one thing. I guess I'm more concerned about the fact that lower interest rates doesn't necessarily translate to more lending, because you know the credit risk, perceived credit risk by the banks go up, and sometimes they just pucker up. And to me, that would be the one time when we might have to see negative interest rates, because somehow, some way, the Fed would have to force the banks to part with some of that money. Yeah. Jeff?
You know, this negative interest rate conversation, I disagree with Dave. You know, it really depends on what the settled rate and economic growth is going to be the driver of that. But a lot of people buy real estate, John. They buy real estate to create rental income. And so no matter what rates are, real estate market is going to be good. At least it is in Florida right now. Maybe not in New York where people are migrating. But Do you think today, shifting the conversation back to investing, that if you're over 55 today and you're within retirement or retiring, that it makes more sense to be dependent on solvency through fixed income creation to create income, so they're dependent on solvency versus equity growth or economic growth going forward? Should a retiree today or pre-retiree have investor balance there, Jon?
Sure, I think they should, Jeff. And like I said, I think that residential real estate, in particular in no tax states like Florida, like Texas, like Nevada, are still going to be great investments. And I'm not talking about single family homes because of, a one-off thing like that. I'm talking about, 200, 300 unit buildings that if you have the opportunity to invest in some of those sorts of opportunities, I think those are the ones that really see, the millennials still don't want to buy. They want to rent. They want experiential. They're going to ride in Ubers and they're going to rent their place. And obviously, in a state like Florida, I think that continues to benefit from the great climate, from the great business climate as well, and that those kinds of opportunities in residential are where I'd like to be.
And average investors can indirectly get involved in some of those investments through private placements and other such things. But last 30 seconds, you were right when you talked to us about what sectors, what industries would do best. You were right over the last 9 weeks. What do you think over the last couple of months the best sectors are going to be?
I think you stick with tech, quite frankly. I mean, Zoom, ZM
5G.
For the meetings and things like that. People think, oh yeah, it was just a flash in the pan. No, not when you're doing 300 million people on various Zoom calls, up from 20 million when the year began. I think those kinds of things, CHGG, which is basically high school and universities online, that allow the professors to, work with the students and things like that. These are things that are going to continue going forward. It's not like when we reopen, they just stop. So technology in particular.
You mentioned the 5G too. I kind of had a feeling you were going to say that after the 5G comment. Jon, whenever I talk to you, I always wish we had more time, but unfortunately we're out of time. But thanks so much for being back with us again. Love to have you back in a couple months and get some more words of wisdom from you then.
Look forward to it. Thanks, Dave. Thank you, Jeff.
Very welcome. And you stay with us too. We'll be right back here in a moment on The Income Generation.